Hello, everyone. Welcome to today's webinar. So excited. My name is Liz. So excited to have everyone on today as you're joining. We're going to start in a couple moments here, but thank you so much for being here. Really appreciate everyone's time. We're going to be talking about how to thrive financially right now in today's economy with Nicole. I'm going to bring her on here in a moment. So bear with us as you're coming on. Please say hello in the chat box. Please share where you're calling in from. And what you're excited about learning today. We are very committed at the investor community to provide that for you, right? To really make your time well spent. So thanks again for being here. Just going to take a moment here as folks are coming in. I'm going to get Nicole part of my as a panelist so we can get going. But please share in the chat box if you can where you're calling in from. That would be great. Okay, I don't see her yet in our attendees. So, hey, Noor, how are you? Good to see you. Noor's one of our Strive members. Good to see you, Noor. All right. Fort Lauderdale, great to have you. Hey, April, nice to see you as well. Roberta, how are you doing, my friend? Hope you're doing well. I'm excited to see some updates from you. You know what I'm talking about. Hi, Elizabeth. Hi, Marta. Hey, Wendy. Great to see everybody. All right, I'm just going to check on where Nicole is, and we'll get rolling here. Give me a second here. All right, just bear with me, everyone. But yeah, if you're joining us, just bear with me for a moment. Please share in the chat box where you're calling in from, and what what you're excited about learning about today. I'm waiting in for Liz. Okay. Let me make sure I'm not missing something here. But yeah, welcome everyone here. We're just, I'm just making sure I can get Nicole added here. And I'm just double checking what's going on. So great to have everybody here today. Hey, Belinda. All right. I'm gonna just put you guys on mute. If you're coming in, welcome. I'm just getting Nicole added as my co-host here. So just bear with me as we do that, and we'll go from there. But please share your name, where you're calling in from, and what you're excited about learning today about. All right, let's look here. I wonder what's going on here. Just bear with me. All right. Hello, Macy. All right. Why don't I see Nicole? All right, just bear with me, everybody. But yeah, please share where you're calling in from as we're getting going, and what you're excited and what you're interested, I should say, what you're interested in learning about as I get Nicole here. So just bear with us. Okay. All right, I'm just going to give. Welcome, everyone. Just bear with me as I'm getting, trying to get Nicole added here. And I'm just trying to troubleshoot a little bit, but welcome to our webinar today. It is 3 o'clock Eastern time, and be with you here in a second. Okay. All right, Nicole, if you're on here, I'm not finding you. So I want to make sure I promote you, and I'm troubleshooting here where our presenter is. So just bear with me here. Okay. Okay, let's see here. It's only one Nicole. I wonder if that's Nicole. All right. Okay. I'm going to put myself on mute. You are in the right place. Just bear with me for a couple minutes. We'll get our presenter on, but I just want to make sure I'm clear on why I don't see her here. And so I want to be able to promote her. So just bear with me, everyone, for one moment here. All right, but you are in the right place. Just bear with me here, and as we get Nicole added, I'm just Not sure what's going on here. So I know she said she was waiting. So you are in the right place. My name is Liz. You're here with the real estate investor community. Just bear with us here as I get her added and know what's going on here because I don't see her. So I'm just trying to manage that funness. Okay. 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 Awesome, Elizabeth. Yeah, just all right. I don't know where our presenter is, but bear with us, guys. All right. Just please have a moment here, and I will be with you all in a second because I want to get Nicole on. Okay. Okay. Just keep bearing with me here as I try to manage this. Okay. And Nicole, if you are on, I'm assuming you're not because I cannot find you. Just put a note in the chat box here. I would appreciate that because I'm struggling here to find Nicole here. So all right. But in the chat box, make this interesting while we wait. I'm going to just ad-lib here. In the chat box, when it comes to financing, today's topic is all about, really financing your deals. And Nicole has a tremendous amount of information. She's a mortgage broker. What are your challenges when it comes to financing in today's economy? So I want everyone that's on, while I figure out what's going on, where our presenter is, please in the chat box, I want you to think about what the challenge that you're moving through. And I'd like everyone to just keep an eye on that in the chat box. So I keep you engaged, and just bear with me here on trying to get Nicole on here. Okay. So challenge that you're dealing with when it comes to, I don't think I know, find her phone number. Challenge to deal with when you're in today's market. That's what I love for you to explore, or not explore. Please put in the chat box. That would be great. While we're just still managing, trying to get Nicole added here. Okay. If not, we're gonna change shift. Oh, there. Oh, you're in. Okay. I'm a little confused. I'm very confused right now. I'm in. You're under Gabriella. I'm so confused. Okay, bear with me, guys. You there, Nicole?
Can you hear me?
I can hear you. Yeah, I just made you a co-host.
Yeah, it says that I cannot start my video because the host.
Okay. There's just loads of fun things happening right now, and I don't know why you're under Gabriella, but that's okay. We're gonna keep going here, and we're gonna make this happen. I'm so glad you're here, and I'm so sorry. I have no idea why you're under Gabriella, but that's okay. Let me troubleshoot this. Just give me a second. Everyone, bear with us. We're gonna get going. We got a real dynamo here, and Nicole, we're just gonna get this figured out because I'm just kind of figuring out why we can't see you. Okay, let me do this. I made you the co-host. You can't share your screen?
Oh, there we go.
Oh, all right. Hi, Gabriella or Nicole.
You deal with the technology when it hits you.
Let me just make I got to figure that out. But I am so glad you're here, and I'm so sorry for that. I'm like, Nicole, I'm like, where is she? And I'm like, and I
had the link. I was sitting there 10 minutes before, and I'm like, hey,
and then that's probably what happened.
Yeah.
Okay, everyone take a deep breath. All right. So glad to have you, Nicole, and welcome everyone. Thank you so much for everyone's patience. We really work really hard in our community to start on time and to end on time. So my sincere apologies. This was not Nicole's issue. Just we'll work that through with our team and make sure that doesn't happen again. But Nicole, thanks so much for being on. And thank you everyone for being here. We had taken off June for our free webinars because we had InvestHerCon in May, and that was a lot happening there. So we needed to kind of debrief in June. So as we kick things off again, we have Nicole here. We got a chance to connect with Nicole many years ago, and it was always so impressed with her knowledge and her sincerity to share that knowledge with her clients, with community, with our community. So we never took that lightly. And Nicole was one of our keynotes at InvestHerCon. She shared a lot about how to navigate today's economy, especially from her perspective, right? And it's so helpful to hear. So so excited to have you, Nicole. How have you been?
Liz, I've been a bit busy. It's been intense. Of course, the mortgage industry is down, real estate market is down. But we're talking to, I think, 10 times the number of people to get less transactions. But I think everybody's really just trying to figure out how to navigate this market. So our team has really just turned into an education portal, and we're here and ready and available to support our clients on the lending side when they're ready. But right now, it's just about sharing as much information as we can.
Yeah. And setting everyone up for success, right? Because,
absolutely,
we want women, especially because that's who we serve, we want women to be well educated on what's happening, but not just sit on the sidelines so that fear takes over, but also make the right fiscal decisions and investment decisions, right? So as we kick it off, I know we're starting a little late. I'm not going to go through all the slides that I typically do, but I would just invite everyone that's new, that is really not familiar with the InvestHer community, just put a quick new in the chat box, because I really just want to welcome everyone, all the folks that have been with us and new women that are coming to our community. So thank you. Thank you, Macy. Nice to have you here. Jennifer, Emily. We do 2 events a month that are free. I'm also going to put in the chat box, after I throw it to Nicole to jump into today's topic, our Facebook community. Our Facebook community is a free resource. It's where women can give and get, and where we really are very vigilant that women really set themselves up for success by adding in where they're struggling and where they need support. It's a very safe space. We started with 40 women about 4 years ago, and we have close to 15,000 women now in that Facebook group. So that's one of the best places to start engaging in the community. We have meetups across the country. We have our annual InvestHerCon, and we have a lot happening in our community. But the Facebook community is probably the best way to keep the conversation going. I see Nicole, I see amazing, badass women always answering questions. I see Nicole very active, like many of the more seasoned women are in our group. So thanks for being here. Thanks for ladies coming, the women that are been with us since the beginning. And I'm going to throw it to you, Nicole, to just jump into the content here today. So I'm going to stop talking. I want to help you navigate questions and just be your, as they say, the Vanna White on the side. I don't look like Vanna White, but that's okay. But I'll come back in, in terms of like, I don't know if you're in terms of like 40 minutes, 10 to, we can go over if it's okay. I don't know how your schedule is. If we go over 5 minutes, is that okay with you? Okay. I want to make sure we give you the time and the women asking questions and stuff. So, and this will go to everyone after. So, but thank you for being here, jumping into, how to navigate today's economic landscape with the financing. So thank you for being here.
Well, Liz, thank you so much for having me. And it's always a pleasure. You have such a phenomenal group of just hungry women, right? It's like hungry in the desire to build something for themselves, that financial stability for their families, for generations to come. And it comes from deep within, which that's where I love to reside. I reside there when I'm teaching, when I'm helping a client get financing, or whether I'm just educating. And so that's what we're going to dive into today. The market is rough right now, and I'm going to go over a couple of economic slides really quickly, and then we're going to jump into some lending opportunities. But it's always harder when we're here on Zoom. I just love being in person. Thank you so much for inviting me to the Omni and to InvestHerCon this past year. So I'm looking forward to visiting you guys next year when you do it again. So I'm going to share my slides. Hopefully I can share my slides.
Yeah, hopefully you shouldn't. I'll stay on until I'm not going anywhere either. I'm just going to stop talking. Real quick, everybody, in terms of questions, what's really neat about these, the reason why we don't record these and just send them out to people, and these are live, is because things come up, right? Questions come up, like we want you to take action as a result of these webinars. This is not meant to be like, oh, this is really nice information I'm never going to do anything with, right? That's a waste of everyone's time on a Friday afternoon in the summertime, right? We want this to be useful. We want you to take action. We want you to help you move the needle on your financial freedom journey. So please, if you can, don't put the questions in the chat box. We always ask and request that you put them in the Q&A box. That way, when I come back on, we can really pound them, because we'll go through them quickly. And you're going to have a lot of questions for Nicole. She's going to share a lot of great information with you. So just wanted to say that quickly before I stop talking here.
Yeah. And we're going to go through a lot. I am a content hog. I believe that your time is valuable. I know my time is valuable. So I want to make sure that if we're going to spend whatever we have left, 45 minutes together, that you're getting the most out of this time together. So please do pay attention. It's a Zoom. I've been guilty of putting Outlook right over my Zoom calls as well. Hopefully that we're going to spend this time together. I'm going to share my screen so we don't waste any more of your precious hour together. So guys, this is ultimately, I look at everything through the lens of opportunity, and that's where I'm going to be kind of talking about lending today. I could have taken this presentation in probably 100 different directions, but I filter my conversations, my education in the options that real estate provides. Sometimes it's not about immediate cash flow. Sometimes it's not about incredible appreciation, but it is the doors it unlocks, whether that particular building becomes 2 or 3, or whether you're able to finance it in such a way that you're able to get the cash flow to continue to prosper and put that money into other things. But real estate through the lens of it not being about the money, but about being about the options. So let's jump in. So the United States is short 3 to 7 million homes. A lot of this had to do with the fact that the new builders simply could not keep up, and they haven't since 2008. Right now, they're taking leaps and bounds of the market share, yet they're still under a quarter of all homes sold, but the existing homes are locked up. That is a massive pinch on inventory. That pinch on inventory is going to continue to push prices higher. So anybody that's sitting on the sidelines thinking I'm going to wait for a bubble to burst before I get in because I need prices to come down, I'm afraid you might be waiting too long. What we're seeing this year is more of a normalization of prices, where we did see a little bit of a dip, but as of February, it started coming right back up again, even against higher interest rates. And in fact, this week we had an extremely volatile interest rate week where our interest rates went above 7% again. That does not make me happy. It doesn't make anybody happy, but it's certainly the economics that we're given, and it's our choice that we can either ignore it and turn the other way, or we can grab it and find the opportunities, because I promise you, every market has opportunities. It really just depends on how willing you are to find them, and certainly by partnering with the right team. Rent growth continues to slow down. This is something that's happening across the country. There are pockets that are seeing better rent growth than others, but against higher interest rates, against higher prices, you have slowing rent. That's not adding up. As an investor, that's not positive cash flow. So I want to talk through 10 financing options. And we talked about this as being innovative. And I'm going to stretch your thinking to say innovative really could just simply mean getting back to basics. So we're going to pile through 10 different financing options. And I kind of blurred the line, like there might be 12 in there, but I doubled up a few. So we're going to be talking about 10. Please store up those questions, put them in the Q&A. I'll try to land where we've got enough time for any questions that you have. I've been in mortgage lending for 22 plus years. I'm the #1 originator in the state of Colorado. And I simply say that because I see a lot of transactions. I'm also an investor myself with 24 doors. So I work with a lot of investors. So there's probably not a question that you can ask me that I don't find or can't find the answer to or know the answer to. So let's just jump into the most obvious first, because I can't tell you how many times I've had conversations with investors or clients that come to me saying, I need a DSCR loan. I'm like, why do you need a DSCR loan? Well, because I was told I need a DSCR loan. I'm an investor. And I'm like, okay, can we go through what a DSCR loan is? And the fact that you actually don't own any other properties and you have a W-2 job. I am not going to sell you a DSCR loan, but let's go through the positive and negative of that versus conventional. So this is where I talk about the fact that getting back to the basics might just return you to the best solution on a fixed 30-year product that could support your success. Yet investors tend to leap over what they think they can't qualify for anymore without doing all their due diligence. So let's start out with the most obvious, conventional financing. Huge benefits. You can use this for a primary, putting as little as 3% down if you're a first-time home buyer, 5% down if you're a move up. I work with a ton of investors, early investors who are willing to move, who get into that first home with 3% down, then they move into the second home with 5% down, turning the first one into an investment property. Then they buy the next one and the next one and the next one. In fact, I have 3 kids who all purchased their first home at age 21. The third one already wants to buy her next one. I'm like, you haven't even owned that for a year yet. The other two, the 2 oldest, are already on track to buy their second one, and they're looking at buying a duplex using conventional financing. They both lived in the first one, and now they're going to live in the second one. If you are willing to move, if you're buying a duplex, you have to put a minimum of 15% down. And if you're going to move into a 3 to 4 unit, you have to put a minimum of 20% down. Multi-units, if you're buying them as investments, require 25% down. So this might be an option to whittle that down a little bit, save yourself 10% down and move into it for a year. Use that year, renovate, spruce it up, do the things that you need to increase your cash flow, and then move into the next one. Second homes require a minimum of 10% down, investments a minimum of 15. So a single family home I can do with as little as 15% down. You are not going to like the interest rate, but I can offer it if cash flow is your, or if cash to invest is your biggest issue. And they have generous loan limits. So every year their loan limits increase. So this is just a snippet. You can Google Fannie Mae, Freddie Mac is the exact same. Fannie Mae and Freddie Mac make up FHFA. So that is the overarching governing body for Fannie Mae and Freddie Mac. That's your conventional financing. So you can Google Fannie Mae or Freddie Mac, doesn't matter, loan limits, and it'll pull up the Excel spreadsheet. They both have one, they're the same. And you can see what the loan limits are in your county, and then it breaks it down. But to see the generous loan limits where you could go up to 1.5 million, 1.3 million, 2 million on a fourplex using conventional financing, putting as little as 20% down as a primary home. Given the rental market or rental rates in your market, this might be a phenomenal opportunity to leapfrog building up your portfolio 4 doors at a time, but you got to be willing to move. All right, costs. So I'm going to go through the benefits and costs for each one of these 10 programs. The costs, you got to income qualify. We're going to need your W-2s, your tax returns if you're self-employed. This is not a non-QM loan. You got to qualify. You don't have to be W-2, but you need to be self-employed for a minimum of 2 years, and I need to show net profits in your business. You need to have reserves if you're buying a second home or investment property. You're limited with Fannie Mae and Freddie Mac to 10 financed properties. I've got a lot of investors who will either pay off their smallest loans, or they'll do a blanket loan, a commercial or portfolio blanket loan, put some of those smaller ones into a portfolio product, and then go after more 30-year fixed long-term debt products so that they can cash flow those investments. Absolutely an option we talk about a lot. And then the LLPAs, that's a big cost. The loan level price adjustments just got more expensive. If you guys have been paying attention, those interest rates not only have been going higher because of the market, but especially for investors and second home buyers, they went higher still. So really quickly, I'm going to show you that loan level price adjustment chart. This is not the interest rate. This is the behind the scenes cost to the rate. And you can see where investment properties and second homes cost exactly the same today. It used to be that I could skip around and buy as many second homes as I wanted, and I got a primary home interest rate. Well, that stopped during COVID when a lot of people were buying a lot of second homes. So FHFA got a little smart. They started putting the interest rates for second homes to be equivalent to investment properties. So now a lot of times I'll actually go investment, because now I can use cash flow to qualify for more, the rental income. Second homes, you can't use rental income. Let's jump over to jumbo financing. Jumbo financing in its basic term is any conventional financing over the Fannie Mae and Freddie Mac conventional loan limits. And on the upside, there really is no loan limit. Now, a lot of jumbo aggregators will stop you anywhere between $3 and $4 million, but then other banks will go up higher than that. You have products that are as high as 90%. I used to have a 97% loan to value jumbo loan, but a lot of those went away when we had more risk in the financing market. And then, of course, you can get into luxury rentals. A lot of people, when they think of jumbo financing, think of big homes, but that's not always the case. A lot of times right now, a duplex, modern in the middle of an urban area, might be that jumbo loan where it might tip you over even the loan limits for a duplex. So don't just think, well, that's not me because I'm not buying luxury. You might be in the jumbo market just simply because you're buying a new build or you're buying something with these elevated prices. So the cost to that, the cons, if you will, so cost and cons, same in my head. The cost to that is tighter lending standards, tighter debt to income ratio limits. So typically you're around 43 to 45% versus conventional will go to 50% debt to income. And that's talking about your monthly debts. Loan to value, meaning you typically have to put a little bit more. You have to put 10% down nowadays instead of maybe 5% down for conventional. Credit scores, they typically want higher credit scores. Conventional goes all the way down to 620. You're going to see jumbo really stopping or getting really hard or expensive to get below 700. A lot of them stop at 680. And then we just talked about credit scores, and then all of them require reserves unless you're getting an AUS jumbo, which is a really nice product that we do a lot of that follows conventional financing and does not require reserves. All right, FHA and VA. So that's one of the ones I combined. FHA and VA is a phenomenal product when you're looking to buy multi-units. Now, an FHA and VA only allows for you to do it as a primary home. So you've got to plan to move into one of them. But if you're looking at a single family home, maybe I'm thinking conventional, but if you're looking at a multi-unit, I would explore FHA, especially if it's your first one, because you can put as little as 3.5% down on a 3 or 4 unit with an FHA loan. So that's really good. If you're a veteran, if you've served, thank you for serving your country, our country, and making it a better, obviously, for all of us. But if you did serve, it's a 0% down. I can't tell you how many veterans I have. Every time they get stationed somewhere else, they're buying a multi-unit with either 0 or very little down. Now, we can talk about that. That goes into eligibility criteria for VAs. And once you have one VA loan, you are limited based on your eligibility, but that's going down the rabbit trail for VA. So, but I do want to say that you can buy it, a multi-unit, 3 or 4 unit, 2 unit for 0 down. It allows for lower credit scores. FHA and VA don't really have a minimum, but a lot of lenders will stop at 580 versus conventional stops at 620. Now, they do require that you live in it for the first year, but I can use 75% of the other units. I can do this for conventional as well to help me qualify for more. So people will say, well, I only got pre-qualified for, say, a $500,000 single family. Well, that $500,000 single family with rental income on the other properties might mean that you can qualify for a $750,000 triplex or quadplex, or maybe even a little higher. So that rental income goes a long way in getting you qualified for more. So some of the cons or costs, FHA's got expensive mortgage insurance, 1.75% right up front. It'll get rolled into the loan, so it takes away a little bit from your equity. And then it's got a monthly mortgage insurance that can add up to hundreds of dollars every single month and will take away from your cash flow. FHA is really good to get into it. And then typically a lot of investors will refinance back into a conventional once they've built up the equity. VA has a funding fee up front, no monthly mortgage insurance, and VA has a little twist. So they'll say you cannot use the rental income on those other units unless you have rental income on your tax returns. I'll tell you how to get around that. You hire a property manager. You can piggyback on their experience, and VA will allow you to use your rental income to help you qualify for more if I hit you with that property management fee. So that's a nice little trick from today. A lot of lenders don't know that one. FHA loan limits are also very generous. So you've got FHA loan limits of 472 in the low cost areas. Typically, it's going to follow the conforming loan limit. So if you're in a higher area, but like I'm in Denver, Denver County goes right up to the high loan limit, so 787. But in El Paso or Weld County, it's super low. It makes no sense. It's way lower than conventional. So if you're looking at FHA, absolutely make sure that you don't just think it's the same. It's not, and it might not be. So that can sting you. VA loan limits, there isn't one. There isn't one if you have not used your eligibility. So if your eligibility is free, like you had a loan and you sold it, or you refinanced it, or your first time buying, you could buy a $2 million VA purchase with 0 down. But once you buy that first one and you want to buy a second one, that's where the eligibility restrictions come into play. So let's jump over to cash out refinancing and home equity lines of credit. That's another loan option to get you as an investor into your next property. So cash out refinancing. So one of the benefits, if I go cash out versus HELOC, cash out refinances, that allows you to use that lazy equity. Your primary home is your worst investment. So capitalizing on that. But a lot of people today, they don't want to refinance because I got a really low rate on that loan. But I can show you where if you consolidate a bunch of other debt, that short-term debt that's pinching you every single month, and I roll it into a higher interest rate on a 30-year fixed, I can actually improve your overall monthly cash flow, putting you in a position to be able to qualify for more. As an investor, you need to take a deep dive look at your debts to see if cash out refinance is a way to not only consolidate, but use up some of that equity that you didn't work for, it was given you by the market, to not only roll those debts in, but also to purchase another property. So that's a really good thing. Right now, obviously, you do have the higher rates, but you have one of the big pros with a cash out refinance is you now have a new 30-year fixed payment. Even if it's at a higher interest rate, it's a fixed cost. You can plan against it and you can cash flow against it. A home equity line of credit has a little bit of risk. It's based on the prime rate, so it fluctuates. Yet, it allows me to keep that big loan, the first loan, set with the lower interest rate. So I have a piggyback second, that's that HELOC. Well, if that first loan is really small and that HELOC is really big, you might want to consider doing the cash out refinance. But if that first loan is really big and you're only pulling out a little bit of equity, that's where I'd go with the HELOC option. So the cost is right now, prime is 8.25. Ouch. We've been so used to prime being so low as 3.25 for the longest time. It usually floats 3% higher than the Fed rate. Right now, the Fed rate is 5.25, and it's set to go up twice more. So that prime rate's going to go up. I just had a great conversation with a guy that I actually helped him do a debt consolidation HELOC. He's locking in part of it, opening up the rest of it. He's going to buy an investment property, but I have to qualify him at a higher interest rate because I know that prime rate's going up before we close on his investment. So it's good to know and have somebody that's strategic and knows what the market's doing. It also, though, it allows you interest-only payments, good and bad. That can help you get behind. If you're not staying on top of that loan, it can quickly get behind you and you'll find out that you owe the same amount that you originally borrowed 10 years later, and that's not a good feeling. All right, let's jump into renovation loans. A lot of investors don't know about renovation loans that are conventional because everyone knows about the FHA renovation loans, the 203Ks or the 203KSs. And we're like, well, I can't do a renovation loan because I'm buying it as an investment. Conventional has a home style loan that you can use for second homes and investment properties. Really good information. We have a ton of renovation loans going on right now because we have fix and flippers who want to start holding on because they're seeing opportunities, and ultimately they're not getting the fix and flip gains that they were before. So they're buying them and then we're renovating them, they're refinancing them, and they're going to hold on to them as rentals. So benefits of the renovation loans, you can go conventional, VA, or FHA. You can use it on a primary, second home, or investment, all the way up to a 4-unit. You can roll in all the costs so that you literally bring the minimum down, like 5% down on the conventional. That's crazy. I can buy a $400,000 home. I can do $200,000 in renovations. I can have a property that maybe is worth 600, well, 600,000 I just put into it. Maybe it's worth 750 based on the renovations I did, but I've only got a loan for 600 and I only put 5% down. So that opportunity to build up that equity is massive. Fix it up with no out-of-pocket costs. Now, some of the downsides is you can't do the work. You got to have a contractor for all three of these types of renovation loans. So if you want to do it and save yourself some money, this isn't the loan for you. It has to be a licensed approved contractor. We will add in a contingency factor, so it'll boost up the cost of the loan, but ultimately that will come down slightly once all the numbers have been figured out. And then you have a big risk right now in this market of the appraisal not coming in at value. That's been the clincher on any renovation loan that we're doing right now, is holding our breath for that appraisal. Is the renovations going to give us the lift in value that lets us roll in all of the updating that we want done? And a lot of times it does with good flipper or good renovators, but sometimes when somebody gets a little ahead of their skis, that value won't come in and they end up either having to bring money to the closing table or walking away from that investment. All right, reverse mortgages. Really quickly, a lot of investors are like, wait, what? A reverse mortgage? I know what that is. That's my grandma's loan. It's not just for grandmas. I work with a number of older folks who were not prepared for retirement with a ton of equity in their home. They had a house that was fully paid off, but they don't have enough in their investments to live out the rest of their life. Well, you can do a reverse mortgage if you're over the age of 62 or if you're over the age of 55 with a proprietary product. But if you're over the age of 62, I can tap into that equity and you'll never have a mortgage payment. The bonus is I don't have to hit you with the mortgage payment either in your debt to income ratio. And I can use that equity to go buy investment properties. I had a gal right before COVID, just circumstantial, good timing. She did a reverse mortgage, bought 2 fourplexes with the equity in her primary home at $600,000 each. She got a loan on both of them. She put half down and did a loan for half, $300,000. She sold them about a year ago, 9 months ago. She sold them for $950,000. So she gained $350,000 times 2 by using the equity in her home. And that's a reverse mortgage. She doesn't have to pay that back. That money is now in her account after capital gains, helping her build up that retirement income stream. A little creativity goes a very long way. Your kids don't want the house. They want you to build wealth. They want you to live out a good life where they're not having to pay for it. And then hopefully they want some of those assets when you pass. The downside is the home that you have a reverse mortgage on has to stay as your primary. If you move, you have to refinance or sell the home and pay off the loan. Self-directed IRAs. I get a ton of questions about how can I use a self-directed IRA? I'll tell you, it's got some benefits and it's got some costs. It opens up that IRA so that if you've got money in your retirement accounts and maybe your stock picker isn't really fantastic. Now, I will say that the stock market just had its best 6 months since 1983. So if you didn't gain a good return in the first 6 months of 2023, then maybe it's time to get out. So if you want to invest in something other than stocks, you might look at doing a self-directed IRA. Now, it has to be managed. So you have a custodian that holds that account, and that can be expensive. So that's definitely one of the costs. But it is tax deferred. It does offer diversity, and you can actually become a hard money lender inside your self-directed IRA. You can also buy rental properties, but any monies that come back as rental income has to go right back into that IRA. You cannot live off of that income. It's coming out and going right back into the IRA. You cannot manage the property and you cannot maintenance the property. You can't do any of the work yourself. You have to cost all that out, return invoices, and pay it out from the IRA. There are some additional costs coming from the IRA, so you definitely want to get a little bit more educated on that should you want to go that direction. Bridge loans, a little bit of a nuance, less of a loan program and more of a nuance, but I'm talking to a lot of people about if their current home and they want to buy an investment property, but their opportunities in their current home, some current homes aren't good investments. Just because you own it doesn't mean you should move into the next one as an investment and convert that primary into an investment. It's a good rule of thumb, and I help a lot of investors do it, but not all current primaries. I mean, I just built a beautiful new primary home. This would make an awful investment. It's too expensive and I have too much equity in it. So in that case, if I did want to sell it and I did want to downsize, I would want to do something where I could take advantage of moving into the new home that I want, and maybe even investing in 1 or 2 or 3 other investments. Well, if I don't want to move before I buy, I can look at bridge loan options that capitalize on that equity, free it up, and allow me to purchase other properties before selling the first one. So this also can be utilized with 1031 exchanges. But of course, if you're selling a primary, you don't need to do a 1031 exchange. That's a little bit of a different conversation. So you are going to have a higher interest rate on that bridge loan, and you're going to have points. You're going to typically pay anywhere from 1 to 3 points up front, because this is a short-term loan. The idea is that home that you're selling is either on the market or is about to go on the market, and that loan is typically going to be less than 1 year's time. So that lender wants to get their money all up front. All right, non-QM loans. This is where I told you, all those investors want to jump all the way in to a DSCR loan. And I'm like, whoa, back it up. Let's go through everything else before we get there. Because non-QM loans, while more available to more buyers outside of the constraints of conventional FHA and VA, they cost more. So they're the benefits of non-QM loans: options on options on options. There's a plethora of non-QM options. You can own more than 10 finance properties. You can have high debt. You can have bad credit. You can be post-bankruptcy or foreclosure. You can have less or alternative documentation requirements, and you can get a loan, which is an ARM or an interest only. Those are all benefits. The cost, though, higher interest rates, higher down payment. Typically, a lot of them have prepayment penalties that you want to be aware of, and they're typically not 30-year fixed. So they're not going to give you that really long run fixed cost that you can then plan your investments around. But you've got everything from bank statement loans to 1099 loans, asset-based loans. I'm doing a number of those right now. Those people who did have a great run in the stock market might have more assets than they do income. Whether it's a fix and flip loan, a short-term loan, ITINs and foreign nationals we're doing, and of course, the investor cash flow, which is the DSCR. I'm going to define that one really quickly because that's the one that most investors go to. That's a loan where we don't use your employment, we don't use your income, we don't look at any other properties you own. We only look at the property you're buying, and does the rental income cover the cost? So all you need to do is put a little bit more down if those rental incomes don't cover it 100%. Now on these, you don't need to take 75% of the rent like you do for the conventional FHA and VA loans. You can use 100% of the rent, but it has to cover the mortgage in its entirety. So that's the DSCR loans. Then there's land construction and builder loans. Talking to a lot of investors who are ready to break into that next level. So if you're wanting to buy that single family home, scrape it, and then build a multi-unit where it's zoned for multi-unit, you can do that. So the land cost can actually go towards the equity in the land. A lot of times you might get a loan for that home. If you're planning on scraping it, I will tell you a traditional lender does not want to loan you money on that home, because they're not traditional financing. Conventional FHA and VA is not in the business of financing land. You'll want to buy that from a portfolio or non-QM or broker option, so that we can get you into a property that you can scrape. Then that equity is going to go towards the construction. And then if you're doing that more and more and more, you're going to want to look at builder vertical financing and horizontal. So vertical financing is you as the builder gaining the ground, developing that land, and then developing and doing the construction. So all of those are things that we do as well, but certainly something that you'll want to look into if you're ready to kind of take your investing to the next level. And then alternative financing. So alternative financing is thinking outside the box. It's the everything else loans, right? So you've got portfolio lenders. So something like a small local bank that has a footprint. If you have all of your deposits in that bank, or at least a good chunk of deposits in that bank, they might be more willing to take greater risk, knowing that they've got your assets on hand. So they might loan you things before you're fully eligible or something that they're going to hold on their portfolio. A lease option, lease to buy, seller financing, you could be looking at. You could also look at taking over somebody else's loan. I'm talking to a lot of folks about that with FHA and VA loans right now. Private money lenders is something higher cost for that, but there's a lot of folks getting into the private money market because banks are becoming more restrictive. Because if you haven't noticed, there's some banks that are closing and there's some financial institutions that are certainly getting a little bit more risk intolerant. So the hard money loans, and then of course, crowdfunding. You guys are in a phenomenal group where you're just going to create naturally those relationships that could become partnerships. You guys could create a mini private REIT, a real estate investment trust, or maybe it's just you guys coming into partnership. I will tell you, I'm putting my legal hat on. Maybe I'm putting my mom hat on. I have a lot of kids who are in their 20s coming to me and wanting to buy investment properties together. Makes sense. A lot of the Generation Z or even the youngest of millennials don't have the ability to afford where some real estate prices have gone lately. So they want to have two people not married, best friends, three people come together and buy investment properties. Totally okay, but absolutely protect yourself. If you're not married, you can't get divorced. So if you've got two or three people who are unrelated, even engaged pre-married, and you guys decide not to get married, or you two or three people unrelated decide that you don't want to be in business together anymore, you don't want to own that home anymore, if you don't have an exit strategy that's designed with a lawyer and notarized by everybody, then you're going to find that you're going to be in a little bit of a pickle when you want to get out. So go in with eyes wide open and put yourself in with a good operating agreement and a good exit strategy and a good attorney. It helps. And then have that A team, whoever it is, that lender that knows what you're doing, who knows the products that you need, the real estate agent that's helping you find the products, the CPA that can help you take advantage of all the write-offs, but not write off everything so you no longer qualify, right? That attorney that has your back on the leases and everything else. But all of those people are resources for you in the financing sector. They're people that we tap into. I tap into my attorney all the time when I'm working with investors on their financing. I tap into my CPA all the time. Can you help me out? Can we measure up what the capital gains are? Can we look at how to structure this? Because this is what I'm thinking is the right path, but I want to bounce it up against you to make sure that I don't put them in a bad tax position. Having all of your people lined up is key. And then know what your goals are going in, because this, honestly, I went through a lot of loan programs and some of them are better suited for different long-term and short-term goals. If I know your short-term goals are one thing, I'm not going to advise you to take a financing strategy that might have more costs up front, but be a better long-term solution. So know what your goals are going in, talking to your lender. All right. I want to give you guys something. We're going to pass over to the questions and answer section, but I have this very simple, especially for the newbies. And I want to throw this out. I want to offer it up to Liz as well. But we have a booklet that has the 10 rules of successful real estate investing, some of the loan options and financing options that you can have, and some of the things that I sit down and I go through this book with all of my first-time investors, and I wanted to share that with you. So if you want that, scan this code, and otherwise we'll put my contact information in the chat. So I'm going to stop sharing my screen, Miss Liz.
Awesome, awesome. That was great. I got a bunch of questions here. So let's see if we can go over these. Sandy, you're asking, how does the contractor's work get vetted in the renovation loans? Does one send in pictures, or is there an inspection by the bank?
That is a fantastic question, because we bump into this a lot. A lot of people want to do it themselves, or they have a relative, or it gets a little convoluted. So FHA has a specific list. So if you want to do an FHA 203K, you're going to need to pick a HUD approved contractor. If you want to do the conventional, we just have to do a background. So we're going to look at their licensing. We're going to make sure that they're insured. And then we're going to make sure that they're not you and they're not related to you. So that's really, we have to vet the contractor, and then we're going to get all of their bids and proposals. We're going to give that to the appraiser, because he's going to do a to-be appraisal, not an as-is. He's going to take all of those adjustments in mind, and he's going to do a to-be appraisal. And then, of course, that construction loan is going to have inspection periods we're just going to release the funds as the construction is completed.
Got it. That's great. Thank you for asking that, Sandy. Elizabeth. Hey, Elizabeth, how you doing? Are the approved GCs for the conventional renovation loans the same as for the 203K? I've always avoided because I have heard that they aren't the best GCs and charge more because they're on a limited list. And she said,
I don't know if it's 100% true, but they're not the same. So anybody can be a GC for conventional. We just need to make sure that they are licensed and insured.
Okay.
Yeah.
Got it. And real quick too, Nicole, as women are asking questions, can you please put your information
Yes.
in the chat again? Oh, there you go. Perfect.
Yeah.
Okay. All right. Couple more questions here. And Elizabeth, you're also asking, can I get a GC of my choosing approved? I think you answered that. I think you got that question answered.
Yeah,
okay.
You choose a contractor. You just have to submit all their documents.
Gotcha. Yep. Jeannie, hey, Jeannie, you're asking, recently you spoke with your local lender in Columbus, Ohio, who we have a very good relationship with, started to invest in Columbus. The mortgages they have to offer right now have a price adjustment cost for rental properties. Can you explain what this is? And is it pretty standard right now? It's a great question.
It is a great question. Those are the loan level price adjustments. I showed you that grid, and it's expensive. So you might have with 20% down is the most expensive. And everybody wants to put 20% down because they think, well, I'm just getting out of mortgage insurance. Well, ultimately that 20% down, the lenders love mortgage insurance. And if you don't have mortgage insurance and you're right on the line, I'm going to penalize you for that. And it's not the lender, it's Fannie Mae and Freddie Mac. So they'll have a price adjustment that could be as much as 4 points. It's actually 4.125 for that 20% down. So think about that. That's if a market rate today is 7, I hate even saying that. If a national market rate today is 7, 7 and 8 for primary home, great credit, the whole thing, the cost for that might be 100, right? The par rate. So it's 7%. So in order to get to 7% as an investor, I have to pay 4.125 in points. So that's 4% of my loan amount to get down to there. So most investors don't. They'll pay 1 or 2 points and they'll land maybe at 8.5-ish.
Makes sense.
Yeah.
That's good. Good question too. Hey, Belinda, could you please speak as to the reason banks sit on your loans after receiving all paperwork and appraisal report? Oh, sit on, like meaning they don't take action. Okay, gotcha. I'm like, sit on. I was like visually seeing someone sitting on something. I was like, I'm not, it's a Friday afternoon, right? My head.
Totally. I'm not sure why we don't have a cocktail. I can't tell you why some lenders sit on their loan. Yeah. I mean, ultimately, some lenders are busy. Some don't know how to find the solution. Some lenders prioritize incorrectly. I don't know.
I think the big thing too right now, and I always say, you should be looking for financing when you don't need it. It's just like anything, right? You should be looking for team members when you don't need them. So it's always hard when you really, so building those relationships and asking, I think, lenders' appetite for the type of projects you're looking at, the type of financing you're looking for is really, really important, because not all lenders are created equal. Not all want to lend right now, more conservative, more, less conservative. So you really have to know people, lenders' appetite. They're literally not created equal. So that's important. That's really why sometimes they sit on things, because they actually are so conservative and they're just being nice and not saying what they really should be saying, is like, this is not aligned with where we're headed or something. I don't know if you see that, Nicole. The sitting on is just like a quiet way to say that they don't have the appetite for that particular project in this particular economy in that particular market, right?
100%. I mean, you had during the busy years, right? During the pandemic years, you had a lot of lenders who weren't doing down payment assistance loans. They weren't doing hard loans. They weren't doing loans for people that annoyed them or bugged them or emailed them too much. I mean, they just chose because we had an abundance. Now you have lenders who are trying to find and scare up every deal, but maybe their house, their lending company or mortgage company doesn't have an appetite, as you mentioned, for that loan. Or maybe they're just in over their head where they were doing a ton of 15 to 25% down purchases. And now I got to tell you, the loans today are harder than they've been in a long time, because people who couldn't, that were priced out, who were feared out, they're trying to get back in, and every loan has some sort of level of difficulty to it. So if I don't have the stomach or appetite for that, it might just take me longer to work through it.
Yeah. And if you're getting such quietness from your lender or the lender that you're kind of communicating with, you got to be direct with them. Like, is this something that you're interested in lending on? Sometimes you have to be that specific and that direct, because they may not be with you. So increase that dominance, ladies, and really just like get to the point with these people, because you don't want them to waste your time. All right, Nicole, what do you think about financing a BRRRR with a 0% down, too risky? For those who are new to investing, I know a lot of you ladies are doing BRRRRs, but it's buying, it's renovating, it's renting, it's refinancing, and it's repeating, right? That's what those R's mean. So what do you think about refinancing a BRRRR with 0% down, too risky? What do you think?
So here, it's the same issue that I'm having right now with a lot of lenders who were talking about, and I hated the statement. It was the marry the house, date the rate. I don't know if you guys heard that. It was this idea that you could just refinance quickly. You're really getting into a home at the price, and then the rate is inconsequential because you're only dating it. You're going to refinance lower. The same problem is existing with the BRRRRs. You're counting on something that you have no control over. The interest rates didn't come down yet, and it's been a year, more than a year, and it could be another year. And so if you're in a situation that was too expensive and that interest rate was too high and your cash flow is negative, or you can't afford it, then you put yourself in a position where your dating plan was short-term and it ended up being long-term. The BRRRR with 0 down is the same problem. Right now, you're in a higher interest rates, your cash flow might be pinched, and we're not seeing double-digit appreciation. We're seeing an increase, but it's just ticking up. And I think it'll just tick up until interest rates drop, and then we're going to see a jump. And I keep telling people, if you want to get in now in front of that jump to afford yourself the equity. At least that's my humble opinion, right? So right now, you're not getting it. So if your plan is to refinance it quickly, you might not get there. And it might take you a year or 2 or 3 to get to the 20% down that you need to refinance it into, say, a conventional financing platform.
Yeah, that's a great point.
Yeah.
I think in general, I think as an investor, you have to think about, how do I mitigate risk?
Yes.
And so if you're not thinking about that as an investor, it's just, you're going to be behind the 8 ball of a deal. You always want to be thinking, not so it stops you from making decisions. I think it actually creating that healthy mindset, so you can create a business plan that works and you profit from, and that it grows in appreciation versus it not. So again, how do I mitigate the risk here? Should always be your question as an investor, and not so it prevents you, but it sets you up for success. Something I wish I asked
Liz,
myself many moons ago.
Agreed. I wish I knew half of what I know today.
That's the truth.
I was 22. I'm not. Becky asked a great question. She said the BRRRR rules have changed now. FHFA, which is conventional financing, makes you wait 12 months to cash out. And they do, but not all BRRRRs goal is to cash out. I mean, if you build a ton of equity and you want to pull that money out to go reinvest it again, absolutely. Now you have to wait the 12 months, which you didn't have to before. But a lot of the BRRRRs might just want to be, you're putting minimum down, you're doing the renovations, and you're just trying to get it to where maybe it's a 20%, maybe you're dropping the interest rate, and maybe you're dropping mortgage insurance. So you're putting yourself in a better cash flow. There's no waiting period for a rate and term refinance.
So a great point. And you can actually structure it where you get into a great deal, and the refinance just doesn't happen right now or in the next 12 months, right? So again, time is on your side with real estate. But if it's something that, to your point, you're trying to hedge in that first 12 months, well, that might be a little harder depending on where the interest rates are, right? And whether you're going to be able to maximize it. Talisa, you're asking a great point. Hopefully I didn't kill your name there. You were talking about turnkey providers. Interesting. So you said, let me see here. Where's your question? You're seeing some turnkey providers. Again, turnkey for those who are not familiar, right? They're literally finding the property, renovating the property, putting tenants in. They have property management. Typically, it's really turnkey, where they're literally taking all the guesswork out and giving you the investment, is making it as simple as possible. They're offering this 5% down, and the con is negative cash flow, but pro is appreciation. Do you recommend that? I have an opinion, but what do you think?
I don't have an opinion. I'm gonna leave that one up to you.
I think there's a lot of different. Here's the deal. I don't know if I'd ever buy a property that day one is negative cash flow. That just doesn't make sense to me. I've also invested in more workforce housing. So cash flow has always been more important to me. And secondarily is the appreciation. But you have to look at your long-term goals. Negative cash flow off the bat just doesn't make sense to me as an investor. Maybe some people would differ with that with me. I'd put my money, if I have money to invest and I'm going to get negative cash flow, I'd rather put my money into a fund and get 8% while in something that's liquid. So then that way, when I can put it in with positive cash flow, then I would do that. That's what I would do personally.
The 2-year treasury just went above 5%. Short-term treasury bills are a fantastic way to go versus negative cash flow. So from that perspective, correct. I do have an opinion. I would go flat. Like I was thinking that, buy it already done. I mean,
I wasn't even going down that path. I was thinking more cash flow and appreciation.
So, that's right. I was like,
yeah.
The money is in that. The guy just took your biggest returns, but I'd buy something that's flat that I knew was going to appreciate and I had opportunity down the road to refinance. But I like you, Liz, would never buy something that's negative.
Yeah, that just doesn't make sense. Now, turnkeys do, it's like investing in a syndication, right? In a sense, you're more passive, and that's what a turnkey provider can help you provide if the numbers work, right? And I think it's always when the numbers work, and that's how you have to think of it. Jeannie, you're asking follow up, and we'll go 5 minutes over. And Nicole, thanks so much for your time and your flexibility. And again, everyone's so sorry for the mishap at the beginning. Jeannie, you're asking follow up to your question: should I keep shopping, or is it that going to be likely the case across the board? Jeannie, you were asking about the local lender in Columbus, Ohio. Yeah. Mortgages price adjustment. So do you think she should keep shopping?
I would get a second opinion. And of course, I don't want to do a self plug. We're licensed in 50 states. I'm happy to give you one without any even expectation. I'm happy to go, here's what the market rate is for that. If you want to work with your local lender, but you just want an unbiased opinion, or just get a second local opinion. But the LLPs are a real deal, and they're impacting every single lender. So you're probably going to hit up against that. But then their margins on top of the LLPAs, the loan level price adjustments, might be different than another lender.
Nicole, I have a question for you. So what that pops in my head is, when we were growing our portfolio, we always were like local lenders. Local small banks are always the best place to go from a lending perspective.
Yeah.
What are your thoughts right now to that point where you're finding, we've gotten loans on a couple of national lenders that was surprisingly better than the local bank. And I know it varies from market to market, but what are you finding? Does that shift basis of what's happening in the economy, or is it just helpful to shop around both national and local to what I was saying earlier about the appetite? I'm just curious to get your view of that.
So when you're out shopping with a real estate agent and you're in an aggressive market where it's super competitive, a local lender can make a big difference. I know a lot of times here in the Denver market, having my lender letter and going in has won us a lot of deals that we might not have won, and certainly up against the internet-based lenders. Now, having said that, for a refinance or maybe a market that's not as competitive, I'd go with someone you trust. That person might not be in your local market. I might go with a bigger national bank. And if I was refinancing, maybe I'd even look at an internet lender. I have a problem with like the lending trees and those internet lenders.
Sure.
They're so scrap and so low that they don't pay their people very much, which is fine. It's a model and it works for them. But ultimately, you getting closed on time is secondary to them. They don't care.
Yeah.
So you have to figure out where you're at, what you're trying to achieve, what kind of market you're in, and what your tolerance is. Like, can you handle somebody who's not in your backyard?
Yeah. It's a great point. And Sandy, you're asking, thank you for catching that, because I wasn't looking in the chat, about where you think interest rates, when do you think interest rates will be coming down? Let's end on that lovely crystal ball question.
Yes. So my crystal ball has gotten a little fuzzy, but
mine too.
Oh gosh, we were hoping for the second half of this year based on what we saw, the trajectory of inflation numbers. Well, the problem is the headline numbers are doing exactly what we expected. They're dropping like crazy, but that core is super stuck. It's barely moved all year long. And as long as that core inflation numbers don't move, then we're not going to get the drop in interest rates. And now the other side of that, so there's really two perspectives of an interest rate. There's what's going on with inflation, because inflation is a core enemy of interest rates, because it steals your purchasing power. And then what's going on in the financial markets. So everything financial is married to the 10-year treasury. The 10-year treasury is a no risk investment. It's a zero risk investment. So everything is stacked on top of that. Corporate bonds, mortgage bonds, hard money lending is all stacked in perspective to the 10-year treasury. Right now, that spread historically has been 1.65%. That's been the measure of a mortgage risk tolerance, if you will. Right now, it's 3.2%. It's double. And so that financial risk, while we're having issues in the commercial market, we continue to have financial risks of banks failing or banks becoming commercial landlords, which they're not in the business doing. So we need we need core inflation to drop, and we need the financial risk to reduce. Either one of those could drop our interest rates, but I'll tell you, the financial risk right now is the one that's holding our rates so high because that spread is so big. So where do I think that that's going to happen? It's going to happen in between. My prediction is between the first and second quarter of next year. I think we're finally going to get to a period of time where the economy is going to slow down enough, that core inflation is finally going to roll over, and we're going to get some stability in the commercial market. And until we do, there's just too much risk.
Yeah, great insight. And that's the kind of thing that, everyone, there's no crystal ball, but you have to keep your finger on the pulse if you're investing, and not just what's happening everywhere, but like especially your local market where you're looking to invest as well, because that's not just it's not gonna, obviously interest rates are obviously we're in it's going to be impacted nationally, right. But it is knowing what's happening just in general on your local, national, global is really important. And knowing where to go to get those sources. And Nicole's a great resource. I want to just mention this, and I'd love to hear everyone's takeaways. And Nicole, I'd love for you to throw into the chat box your contact info again. Nicole is a great resource. She always has been. She's been on our podcast like 2 or 3 times. So, really appreciate all your insight. Nicole, you're asking about midterm rentals. Midterm rentals is a great, obviously, real estate strategy right now. We're not going to get into all the specifics. I just put an Amazon link. Sarah Weaver and Ziona both wrote a book for Bigger Pockets called 30-Day Stay. Highly recommend it as a resource about 30-day stay and midterm rentals. I know a lot of people are doing very well with that strategy. I'm a long-term investor, long-term rental. I have a more just the more traditional portfolio. But yeah, a lot of people are doing very well with that. And in a sense, like any real estate investing strategy, you got to know, you have to just make sure you have all the specifics and who you're serving. But yeah, I would recommend that as a resource because they're Sarah Weaver and Ziona are both great supporters of our community too. So with that, Nicole, you put your contact info in here again?
I did. I put it right above your book.
Awesome. So highly recommend you to reach out to Nicole. I really want to encourage you. What one thing did you learn today? One takeaway? I think that's so important with anything that you participate in. So you're not this like dormant person watching. We want you to really get something from it and do something with it. And if you have further questions and you want to engage further with Nicole and our community, go to our Facebook group. That's what it's for. Just like, hey, this is what's coming up for me around this topic. What is everyone seeing? And we'll, people jump in and support everyone. And if we see no one answering questions, we usually make sure someone supports you. So make sure you do that. Awesome. Cecilia, thank you. Renovation loans for investors. Great stuff, April. Ginny. Hey, Ginny, I'm looking to refinance out of a property. I need to look at multiple options. Absolutely. And Jeannie, 2 Jeannies. There you go. Good stuff. Is it possible to get a PDF file of today's presentation? So this recording, minus the dead space at the beginning, will be shared with everyone that registered. We had a lot of people register. So this will be going out to everyone that registered. So you will have the presentation. All right. Good stuff. Nicole, thank you so much for your time today. So good to see you again. And please don't be a stranger. We appreciate all your help and support so much.
Absolutely. Always a pleasure. Always a
All
pleasure.
right.
Thank you.
Everyone have a great weekend. Do something with what you learned. All right.
Bye-bye.
Thank you, everyone.